Hello and welcome to the Week in Review. Now, as you can probably tell, I'm not Nick Hubble. That's not Nigel Farage. So Nick Hubble is away on paternity leave, decided to have another child. Good on him. Look forward to the sleepless nights, I'm sure, again for him. I'm Sam Volkery, editor at Southbank Investment Research, and I'm here with our investment director, John Butler. So you will have seen me and John on the Week in Review occasionally from time to time when Nick and Nigel are unavailable. So you're stuck with us today, a little bit different from your usual Week in Review. Nigel's just come out of the jungle, third place, which is a really good effort. I mean, that's the entire time, I think 29 days or something in the jungle, so to speak. But we're not going to dive into that too much because I'm not going to lie, I didn't watch all that much of it. John, I'm not sure about you. Did you manage to catch much of Nigel in the jungle?
I didn't watch any of it live. I saw some of the excerpts that were being shared around on social media, including by Nigel himself, who took full advantage of this, it seems, to indulge in a bit of additional self-promotion above and beyond what he normally does.
It was quite the event, and he did fantastically well. So we must congratulate Nigel on his success in the jungle, and it looks like it's certainly brought a whole new audience to what he covers. Anyway, you'll hear more about that, I'm sure, from Nick and Nigel next week after, and so forth. But today, John and I want to have a little bit of a chat to you today, actually, John, about. Well, I read the headline on Bloomberg, and I'm going to read it verbatim because I loved this. It was the first thing I saw this morning, and it says, Wall Street traders go all in on, and this is the bit I love the most, the great monetary pivot of 2024. So basically, the Fed is suggesting that rate cuts are coming, and the markets went bonkers yesterday afternoon. Pretty much everything was up. Are we now at the verge of a great monetary pivot of 2024? Is this legit, or are they kind of just trying to make us feel good about the market still?
No, I think it's right. I think the reaction is reasonable. I mean, look, markets have been kind of salivating at the mouth for the Fed to give some sort of indication that, yes, absolutely, rates have peaked, and at some point next year they're coming down. And so they were given every reason to go ahead and jump all over this yesterday. And this morning, we also see a positive reaction in Europe. We see stock markets higher. We see commodities higher, both industrial commodities and non-industrial, such as gold, for example, which is a lot higher. So you've seen a very substantial reaction, which totally makes sense. And the fact is that the Bloomberg headline is, in a way, it's actually pretty good because we've gone through this prolonged period of outright contraction in the money supply, in credit growth. And that's pretty unusual. And this is the unwinding of a lot of the stimulus that came through during COVID, et cetera. So that's being taken away. Inflation rates have come way down, partly as a result of that, partly due to base effects. It's a bit of both. But the reality is that central banks they're kind of implicitly patting themselves on the back, not for having created that wave of inflation in the first place, but for having dealt with it without completely driving their economies into the tank and causing a financial crisis. But I wonder if that back patting is a little bit premature, actually. We'll have to wait and see on that one.
Yeah, I mean, I guess that's the thing. If the question I think that always sits in my mind is that they've got rates higher, and the numbers that they release suggest that they have inflation under control. That doesn't feel like it's necessarily reflected in the real world. I mean, you know as good as I do, when you go to the supermarket, prices aren't coming down at all. My hesitation was if they start to aggressively cut, and I guess maybe that it's the speed at which they cut and the depth at which they go. Does this lead to just a further inflation problem? If rates come down, that would be handy for mortgage holders and not so necessarily great for savers. But does that then make the cost of living even worse? Does this really crunch people at the wallet rather than in the market?
Well, this is kind of what I'm getting at when I say that any celebration on the part of central bankers is probably premature here. The fact is, structurally, we do appear to be in what is best called stagflation. That is, to the extent that growth is positive, it's not strongly positive. If you look at it in terms of per capita, per worker, in terms of productivity growth, the things that ultimately matter long term for economic health, none of that looks good. None of it. And yet, as you say, inflation may have come down, but it's still positive. It's not as if prices are falling. And indeed, one could argue that the economy is so leveraged here in the UK, the US, around the world currently, that an outright decline in prices, outright deflation, would almost immediately cause a financial crisis and would have to be met with some sort of unexpected, unprecedented policy response a la 2008 or something. So we're not in a good state. Okay. And so it remains to be seen how the markets are going to respond going forward. And this is when, if you drill down into recent market price action, it actually looks less healthy. So, for example, okay, markets are up, as I said just a moment ago, but they're being led by the usual suspects. They're being led by big tech. They're being led by a handful of bellwether firms in these areas that have done disproportionately well in recent years. But if you look at the bread and butter cyclical sectors, materials, industrials, ex-defense, that's an important adjustment to make, they're not doing well. They haven't been doing well for a while. They're trading at valuations that suggest, if anything, a recession is on the way. So, watch this space because there is, but beneath this, put it this way, those who actually have their fingers on the pulse are concerned about the patient.
Yeah.
Whereas those who are just looking at the patient from the viewing window outside the room think things are okay. So I'm not sure that's sustainable here.
Yeah, it feels like they're suggesting one thing, but the old, they're saying one thing, but when you actually look at what's happening, it's a quite a different story. And as you rightly point out, it is still big tech that's driving forward. I mean, I think AMD was up like 18% over the week because they were, pushing out new chiplet patents and new CPU and GPU designs, and it's like, well, all of a sudden, the market suggests, pockets are looking at recession, but then all of a sudden these big tech is, 200, 300, 400, $500 billion companies are up, 10, 20, 30% over, the last couple of weeks. And that does seem to be shouldering a lot of the market in terms of making it look better than perhaps it actually is. But if the rate cuts come, do you think, I mean, and I've seen this in probably the last month, it seems to be a loosening of capital again, that capital wants to find its way into growth areas of investment. And in the AI space in particular, Elon Musk is pretty much locked down another $1 billion to raise for the XAI project that he's working on, which is X.com's AI project. What was the other one? I think it was Anthropic raised a whole bunch more money. Mistral raised a whole bunch of money, giving them they raised about $400 million, giving them like a $2 billion valuation. So there's money that's starting to flow into these really high growth areas again. If the Fed cuts, and I kind of say this because when the Fed does something, the Bank of England tends to just react, but just a little bit later. So if rate cuts come in the US, and then we would expect that probably come in the UK as well. Do you think this is going to fuel, if this is all coming in 24, is this going to fuel the markets? Are we looking at a 2024 kind of melt up, so to speak, or will it be a little bit more subdued because of, to say, what's sort of really happening in sort of the non-tech sector?
Well, I think a melt up is probably what economic officials would like to see. That is, they'd like to see some sort of soft landing Goldilocks next year. That's what they're trying to accomplish. And as you rightly point out, let's face it, right? When it comes to big tech or anything else that has the zeitgeist behind it, there is liquidity out there. What I mentioned earlier about money and credit growth being outright negative over the past 18 months or so, yes, that's true. But there was so much excess money and credit sloshing around that we've only begun to mop it up with the sponge, right? And so you've still got a lot of it that is looking for a home. And the moment people see that the rate outlook longer term is improving because of the great monetary pivot, as per the Bloomberg headline, then there is a rush. There is a rush to get reinvested ASAP and take advantage of that. And the big tech benefits from that for two reasons. First of all, their valuations are largely so-called intangibles, which tend to be based on very long-term growth assumptions. And the compound effects of interest rate discounting, run the numbers, run the maths, you can just see it in the spreadsheet. Other factors equal, intangibles benefit disproportionately from a changing interest rate outlook in this way. But the second reason is, and this is what we forget, is that the performance of tech as a sector, and this goes back decades, the performance of tech as a sector is surprisingly cyclical. Yes, it may be on a long-term secular growth trend. I don't deny that. But there's a lot of cyclical noise around that secular growth trend. And if you step back and look at some longer-term charts, you'll see exactly what I mean. And so tech really can get whacked if the broader economy does surprisingly poorly. And so this is my personal opinion. You may not share it, but I think big tech is entering 2024 with a lot of risk around it. In fact, my most recent article was titled Big Tech, Big Expensive. It just looks so expensive vis-a-vis the broader market. And indeed, big tech looks expensive versus small tech. So if you want to be in tech, I'd be a bit more selective. I mean, that's my view. And again, you may not share that.
No, I mean, surprisingly, I think that big tech, it does look stupidly expensive. And I wonder that, I was looking at the markets the other day, and I was looking at Microsoft's market cap, and Microsoft's market cap's like $2.7 trillion now. I was like, hang on a minute, wasn't it? It felt like it was only yesterday they crossed the $1 trillion mark, and now all of a sudden they're closer to $3 trillion. And I was like, okay, I get Microsoft's, important in many aspects, and cloud and software, and they're certainly obviously pushing forward on the AI button. But geez, $3 trillion. That's tough to get your head around. Trillion's the new billion, and I remember when billion used to be the new million, and I'm not that old. So,
that's inflation for you.
That is, and that is inflation for you. But when I look at the likes of Microsoft and Google and Meta and Nvidia and these companies that have been really holding up the market, I wonder what their picture looks like if the sort of the AI thing hadn't come about in the way that it has in the last 12 sort of 18 months. If you remove that picture, how do they look? And I wonder if they're anywhere near as attractive based on sort of taking that out of the equation and just being overpriced. But having said that, you're right that it's the small tech that now tends to get overlooked, because if you've got a mega cap that's doing 200% in a year, it's pretty hard to look outside of those kinds of investments. But it's small. I think smaller tech is grossly undervalued compared to what big tech has been able to achieve.
Well, and this is where I so appreciate the work that you do, because I wear various hats and I look at various things, and I have my own areas of expertise, and we all naturally focus on those. But you spend a lot of time looking at what you might call small tech, and I really think that's where it's at now. I mean, don't get me wrong, I tech in general, you could argue, fine, is a bit overvalued, and yet that argument becomes very, very difficult to make when you do drill down. And there are some fantastic stories out there, and it's these gemstones hidden between the big rocks of big tech that we should be looking for, that investors should be looking for. And this is where, again, interest rates, fine. They go up, they go down. Markets go down, they go up as a result of those changing expectations. But as an investor, you really have to try to get past that. That's a game that big institutions are playing day in and day out. You really don't want to try to go head to head with them on that. You want to try to play your own game more cleverly and more subtly, and just think longer term and be patient. Find those gems hiding between the rocks. That's the way forward next year, and indeed, one could argue that's always the best way to invest.
Yeah, and I think it's certainly that combination of, if you've got some great value plays in a portfolio that, if you look through the market, you will find there is a plethora of companies that are, financially sound, got a strong dividend, that can be somewhat defensive to some of these cycles and to things like rate cuts or rate rises, and still provide that kind of stability in your portfolio. And then it's kind of, you clip off some of that return or that income that you can get from some of these things, and you make these smaller sort of asymmetrical plays into the more high growth stuff that is often overlooked or undervalued. And I think that's when you can get the right mix and balance. I think it doesn't really matter what the Fed or the Bank of England actually do.
Exactly.
You can kind of work your way around things that are basically out of your control, more or less.
That's right.
But anyway, having said that, we will have to wrap it up today. It's a short and sharp one from John and I. Actually, while on the subject of AI, we've got actually a new briefing coming out about the AI revolution, which you may be able to see. I think there's going to be a link to that at the bottom of this video today. So click on that. Check it out. As you may have seen me discuss with Nick a few weeks ago, the AI revolution is well and truly upon us. As I was saying to John before, capital is 100% flowing into this at a rate of knots. I mean, if Elon can raise $1 billion at the click of his fingers, there's a lot of money waiting on the sidelines looking for an opportunity like AI. So I've got a new briefing coming out. Make sure you click on the link around this video and check that out. But I want to thank you, John, for jumping in with me, the substitute Hubble-Farage combination for this week in review. Thank you, everyone, for watching. I probably won't be back with you next week, but it'll be back to Nick and Nigel, I'm pretty sure. So thanks for watching, and bye for now.
Well, thank you for watching, and I hope you agree it's never been more important to take control of your own money, your own financial situation. We do a daily free email, a Fortune and Freedom daily email with lots of knowledge, lots of insight. It's a very useful way of protecting yourself for the future. So please click the link in the description or go to fortuneandfreedom.com and get my daily email.